Now is the time for you to take control of your financial literacy. In today's video, we're going to be looking at everything from the investing side to getting rid of credit card debt, saving, being frugal within this compilation of this week's teaching and financial education. So let's take a look at it, and I hope you enjoy it. In today's economic landscape, credit card debt has become a pressing issue for Americans, and now looking at the total bill of $1.14 trillion or roughly $8,000 per American. The alarming trend has continued when we see record high interest rates, including record high balances, which is causing more Americans to default on their payments and also max out their credit limits, having a huge impact on their credit score. Now, this is a major problem in America when it comes to credit card debt, and working in a financial institution and doing the financial education and financial counseling, we are seeing this as a crippling effect for Americans. When you start looking at the perfect storm of the credit debt accumulation that we're seeing in this nation, the Federal Reserve has shown and has started to move those rates down. We are still seeing people that are overrun by debt. For a lot of Americans, this poses the question, how do you reduce your credit card debt without debt settlement? Now, of course, this is going to keep that credit score intact. And I want to go through a couple different ways that we can do this to actually repay your debt. Now, the first one, and the biggest caveat to this, is you have to stop using the cards. That is the biggest one, regardless of any method that I share with you that you utilize. You have to stop using the card. It is what is going to continue this perpetual debt cycle, and it will never end until you stop using the cards themselves. Now, the first one we look at is transferring your balance. Now, of course, many credit card issuers will offer that 0%. It is a big introductory rate, and a lot of people do go for it. We've seen them for 12 months, 18 months. We have even seen some 0% for 24 months. By transferring a high rate credit card, when we look at 22, 25, 30%, moving that rate to a much lower rate really can help you pay it off, which again, if you're not accumulating new debt on that card, that is going to be the game changer. This, of course, with your regular payment is going to reduce the balance owed much faster because you are paying that 0%. Now, the pros of this, you can save a ton of money on interest. And of course, you're paying that principal much quicker because none of it is going towards interest. If you have, let's say, for instance, a $250 payment, move it to a 0%, continue making that $250 payment. You're going to be really going through a lot of interest on that card if you stick with the same payment. What I see a lot of times is people transfer the balance. All of a sudden, they want to make the new much lower payment because it's only interest. And of course, the balance isn't moving as fast as they can. Now, the big con with this, when it comes to pros and cons, is there usually is a balance transfer fee. Some companies charge 3 to 5% of the transfer amount. So if you're transferring over $10,000, they are going to charge you 3 to 5% up front. That is going to be the fee to do that. And of course, if you don't pay it off by the end of the promotion period, if it's a 12 months to 18 months, you're going to have to be stuck with the highest interest rate or whatever interest rate they're currently offering on this card. So what is it the best option for? Who does this really fit? This is the best option for individuals that have incredibly strong credit. If you have poor credit, a lot of times balance transfers are not going to be available. They want individuals that they know are going to make the payments. And of course, that is how it really works. Now, the better option to this is consolidating your debt. Now, we do a lot of debt consolidation. This is taking a multitude of credit cards. Let's say, for instance, you have 10 different credit cards, taking all of that high interest debt, rolling it into one single loan that has a much lower rate. But again, with this consolidation method, it is the exact same. You cannot accumulate and continue using the credit cards when you do the consolidation. This, of course, is going to simplify your payment to one rate, to one payment, but it's also going to make it a little bit more affordable. And the interest rate on a lot of consolidation loans are a lot faster. Now, of course, the pro of this one, you get a lower interest rate on all of the debt that you have, and you have a monthly payment that you can manage. Now, of course, if you want to get out of debt faster, you can go ahead and pay this down a lot faster, eliminating it. Now, another thing that we also see is with a lot of debt consolidation, not only racking up additional debt, is some people are taking out consolidation loans for an extended amount of time. Really, if you're doing a consolidation loan and thinking about paying this off, 24, 36 months, so 2 to 3 years to consolidate this, pay it off, while not accumulating any new debt. What I see individuals do is taking these loans out for 5 years, 6 years, 7 years on a consolidation. Chances are within that time frame, you might have additional expenses, or you might have additional debt, which is what people usually accumulate. Now, the cons of this, you have to qualify for loan. Of course, this has really two big factors. Number one being your credit score. The second one on here is your debt to income ratios. We are getting to a point as Americans where the debt is getting so high, the monthly payments are getting so high. A lot of individuals are not qualifying for consolidation loans because of the debt to income ratios, because again, those credit card balances are too high. So who is this the best option for? Borrowers with good credit, excellent credit, definitely qualify for a lower rate. But of course, you do have to qualify debt to income ratio as well. With people and individuals with poor credit, chances are some of these loans might be at about the same rate. We see them at 18, 20, 22% when it comes to consolidation loans with poor credit. Now, the fourth one we get into is enrolling in debt management. These are plans that are specifically designed to pay off your credit cards over time. Really more of a credit counseling agency. When I think of like Green Path, there's a couple out there that not only lower interest rates, but reduce fees. This is kind of a hands-off approach. This is an approach that I do not like because my education, I'm doing the financial counseling. I can do the same thing as a debt management company, negotiating with creditors with the individuals present. I can do the same thing and I don't charge you a fee. You have to be very cautious with this. A lot of different places will charge you 5%, 10%, 15% as a fee that they're charging for them to manage your debt. You, again, don't want to do this. It's very expensive and it is something that you can do on your own. Now, the pros of this, you can get a lower interest rate. You can also get a lower payment. So some debt places will actually pay off some of your debt to transfer it. They are now pretty much your lender. So you are paying them for the debt settlement. And of course, you have the support of a credit counselor to go ahead and guide you. Now, the con of this, there could be a lot of fees. You could see upfront fees, you could see percentage fees, and it may also take several years to knock out this debt, where you could do it again a lot faster. Now, one thing with this, another con is majority of times they close your credit cards. They'll close your credit lines, they'll close out those credit cards, which of course in short term could lower your credit score. But also if you're an individual, and I do not recommend it at all, that relies on credit cards for that emergency fund because you haven't built it up yet. A lot of people will start just opening new cards. Now, of course, this is for individuals that are not very organized with their payments, and they do want to try to negotiate better terms, but they don't want to do it on their own. And of course, my favorite, the DIY credit negotiators. That's right. You can contact your credit card companies, and not many people know this. You can negotiate for a lower rate. You can go ahead and get a higher limit. You can get a lower rate. You can even settle some of your debt for less than you owe. There's a lot of different ways that they can do. If successful in this methodology, you can lower your payment, reducing the interest rate, also really warding off the negative credit impact. The credit card companies want to get paid. That's it. Even if they get paid a little bit less, a lot of the companies are okay with it, especially from very, very good customers that have paid them for an extended amount of time. Now, of course, the con, creditors might just say no. A lot of them within a rising rate environment, which now we're getting to the point where you kind of are seeing rates go lower. But of course, they can just flat out say no if you don't have, and honestly, you don't have any negotiating room short of just, staying on top of your payments, not paying as much interest by paying down the balances, and also not paying any fees. Now, of course, this is really confident on you and making sure and building the accountability for yourself. When it comes to this option, it is all about you. It is about doing everything yourself. So the bottom line here, guys, debt can be super overwhelming. You have a ton of different ways that you can manage it, but of course, living within your means and really focusing on building and eliminating that debt, getting to the debt-free journey by managing and budgeting properly is the biggest way that you can really get this to align with your financial goals. Thinking big picture, being debt-free involves a combination of strategy, patience, time, and commitment to changing that financial mindset. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video. Join me as I take the challenge to map out your retirement plan starting from day one. Now, early retirement for a lot of people is the ultimate dream. It means you don't have to work that 9 to 5, you're done with your day job, and you can spend your days doing what you truly love. Now, the concept of early retirement with the FIRE movement, everything else we've seen has gained a lot of popularity for really good reason. It gives you the sensibility to really have freedom, flexibility, opportunity to do what you want to and really pursue your passions without having the burden of the paycheck that most of us have until we're 65, 70, even looking at 69 years of age before you get into retirement. Now, one big misconception that we see is that retirement is only for financially privileged individuals, people who hit the lotto or fall into really a windfall. But the truth is, the goal set is really achieved through careful planning, discipline, and patience. Investing over the long term is really what makes this possibility a reality when it comes to investing. Now, of course, the biggest obstacle for most people is the mindset, thinking we need to work till we're 65, where you don't. If you plan this out properly, starting from day one, you can do this. The thing is, the earlier that you start, the easier this plan is, the more time your money has to grow, has time to compound, the greater chances of you achieving that financial independence and living right back here, this debt-free journey. So another conception we also see is that sacrificing your current lifestyle is required to hit retirement. Now, of course, that doesn't mean you have to cut back on everything. When you think of dining out, when you think of travel, when you think about enjoying your life, being able to sacrifice your current life to achieve your financial future that you want, you can kind of do both, but you have to do it really with a caveat because it's not necessarily true. For a majority of us, it is really the adjustments of our daily habits, becoming very intentional with what we spend money on, how we spend money, and honestly, how we manage money without feeling deprived. When it comes to that daily Starbucks coffee, if that's what you want, absolutely. If you love going on the movies, if you love going to vacation, you know what? For a majority of us, there are a lot of things in life that we love that we don't want to cut out, that we don't want to sacrifice along the way. But how can you work it into your budget? How can you make it logical? And of course, when you get it, is it worth it in the end? That is a question that only you can answer in those comments down below. Now, many of us get caught up with having a perfect plan before we start moving forward. This, of course, one size fit all does not work when it comes to retirement, when it comes to financial education, when it comes to financial counseling. There is no one size fits all solution, especially when it comes to retirement planning. When you work with someone and when you do look at their financial situation, you can take small steps towards a very committed goal. And of course, when you start looking big picture, for a lot of people, they don't actually go out. They don't start looking at financial goals. They don't start planning. They don't start breaking it down because a lot of people, number one, feel overwhelmed with the financial goals. And the second one, they don't know where to begin. That is where this video comes in. Again, really kind of breaking it down. When you think of early retirees and when you think of the ability to really retire early, for starters, it is the financial goals. So where are we going to get and how are you going to get there? So for a lot of people, creating the plan to get there means crunching some numbers, setting a retirement date. This, of course, for most people is just a generic future date. They're not worried about it. They're going to be worried about it when they're 35. Then that turns into 45. Then that turns into 55. And then guess what? Eventually, when they're 65, they might be able to retire or they might start thinking about it, which of course is way too late. Now, of course, not only setting a date, but what is the budget going to look like for a future you? This, of course, can be a little bit more difficult for individuals, but when you start looking at different investment options, dividend paying stocks, which is what we're getting into, looking at real estate, growing your wealth over time, investing in the market, there's a lot of different ways that you can do this. Me personally, the way that I'm doing it is putting it into heavy growth ETFs. With that heavy growth ETF, having it actually snowballing and compounding for a multitude of years, slowly shifting about every 5 to 10 years over into more dividend paying. That is going to be the supplement income that is going to be provided from the dividend paying ETFs and to supplement Social Security when we get into retirement without having to actually go through and kind of rob that nest egg. We want to keep the nest egg intact. Well, taking off, like Dave Ramsey says, you never kill the golden goose, you just take the eggs that it lays. That way you can have that retirement account forever. Now, one of the key strategies is looking at saving a significant portion of your income. For this, especially in the younger years, this is where the 401k comes in. I am a big proponent of the promotion of the 401k plans. When you think of the employee match, you are guaranteed 100% return. So theoretically, if your company is giving you a 5% match, you put in 5%, they put in 5%, you're automatically getting 100% bonus on your earnings and your investing. You have to be very intentional with the spending, cutting back on expenses, or not even really cutting back, but monitoring where they are, making sure that you're living within inside of your means while you're still saving. Finding ways to increase income over time is another really big strategy that you can. If you save aggressively and invest wisely, this is kind of what we're looking at when you think of the FIRE movement, which is financial independent, retire early. FIRE movement looks at 20, 30, 40, even 50% or more of your income going into retirement accounts, being very, very aggressive if that is a movement you're into. For a majority of people, they cannot make that happen. They cannot commit putting away 50% of their income every single paycheck. But of course, when you think about a sizable nest egg, that is going to help you within the long run. If that is a strategy you want to, you can absolutely do. For a majority of us, putting away 15%, honestly, it seems like a magical number. It seems like a really big number to look at, but being aggressive and really setting it at that 15% makes a big difference. So if you think big picture, let's say you're 22, 25, you start out on your career, you set it at 15%. Next year, you get a 3% raise, you get a 5% raise, you get a 3% raise. All of those raises in the future, you're going to be able to keep in their entirety because that retirement account is already set at 15%. You move into another job, you get a promotion, you get a raise, you get another promotion. When your income steadily increases, you're keeping this locked in and honed in on that 15% that is going into those 401k plans, because that is where the retirement is going to come from. And you'll start seeing, once you start hitting 100K, the snowball really starts taking effect. 150, 200, 250, then it's at $500,000, up to $1 million plus when you start getting into retirement, or even closer to retirement when you feel comfortable, when you're ready to pull the trigger and no longer have that 9-to-5 job. Another strategy is rethinking your lifestyle and living below your means. This, for a majority of Americans, seems like it's almost impossible with what we're paying out nowadays, but this might mean downsizing to a smaller house, might mean selling down to a cheaper car, using public transportation if it's available, looking for free or low-cost hobbies that you can enjoy in your free time, and really budgeting to simplify your life. It becomes incredibly complex when you think of technology, when you think of phones, when you think of cameras, and when you think of subscription services. That is one of my biggest pet peeves. When you start looking at all of the apps that you have, subscription services, gym memberships, when you have car washes, everything is just $7, $9, $20, $30. Everybody is just kind of nickel and diming themselves with the ability to have all of these subscription services, and they get super expensive. So there's a point where we can save money, we can reduce our expenses, we can accelerate the journey, really moving into retirement, especially getting into early retirement. Now, one of my favorite retirement stories is a gentleman that retired about mid-30s, living on an incredibly frugal lifestyle. So when you think of some YouTubers that I've seen, when you think of some individuals, they have retired very, very early, utilizing that FIRE movement like we talked about earlier, living in a smaller apartment, cooking their meals at home, avoiding buying anything that wasn't absolutely necessary, and ultimately they reduced their expenses to almost nothing, meaning that they got to the point where they could live off their investments, they could do whatever they wanted to, and essentially what they're doing is they're buying back time. Think about the time when you're working 9-to-5 and the amount they're saying, let's say you make $25 an hour. That is the value they are placing on your time. And this was the absolute game changer for me, is when you start looking at it that way. What is your time worth? Is your time worth $25 an hour? Are there things in your life that you can essentially offload, you could outsource, you could do anything with to essentially save that $25 an hour? How could you make it not only increasing your income, but how could you reduce your expenses in the same way? But it does really show what is possible when you start thinking of strategies. And when you think of day one, it is about starting that 401k and start retirement, and also might require some sacrifices to really stay committed to the goals. Now, me as a financial counselor, I see a lot of individuals for financial counseling. Most people have zero plan. There is nothing in place. There are no financial goals. There is nothing hard, stuck, put in place to say, I want to retire at 55. I want to retire at 60. I want to have, $1.5 million in investment account. I'm going to live off the dividends. It's going to produce this much money for me. People don't break it down that far yet when it comes to retirement, and they don't understand why they can't retire because they carry too much debt, because they don't have enough income, because they didn't save properly during the years when they really should have. Now remember, the key to early retirement is starting early, taking action today. That is the thing you can do right now. Go ahead, get that employer match, start that 401k, It is not about waiting until you have a perfect plan in place or you know exactly that you're making more money. This is again where some of the baby steps, like Dave Ramsey, when you start eliminating debt, for some people, could be forever, meaning they never start the retirement accounts, never start the 401k plans, and ultimately they are just kind of stuck. But making small, little, really educated steps towards your goal, towards being consistent and also staying committed to the retirement process. So thank you guys for watching the video. I'd love to hear your thoughts about early retirement in the comments below. If you're interested in learning about investment strategies, everything we do financially on this channel, check out some of the other videos. Also subscribe to the channel, and I'll catch you in the next video. What if I told you you could make $100,000 this year with very minimal effort? Seems almost too good to be true. Well, guess what? It is. And in today's video, we're going to be talking about 7 steps that you can do to not only create wealth, but to become rich as an individual. Now, majority of Americans are looking to be wealthy and really putting their efforts in this specific area, breaking down the wealth building steps and understanding that it can play a very significant role in being wealthy, even on a very low or average income, when it comes to these 7 specific things. Now, the first one, adopting the mentality of a wealthy person. So what exactly does this mean? When you think about building wealth, you are accumulating assets. You're looking at things, and really what it means, you're not throwing money away. You know the value of money. You know that money is equivalent to time. The more money that you have, the more time you can actually get back. And it's almost becoming frugal. Now, for me personally, it was about 10 years ago that I really realized this, and going in and making sure that my money, things that I'm buying, have value, that they have a value add to me. It is not about the egos. It's not about keeping up with the Joneses. It's not about the lifestyle creep. It is about things that are going to add really value and true value to my life itself, which for me personally, having a family is huge when it comes to being able to spend that time. Now, the second one we look at, eliminating all of the bad debt. Now, when we talk about bad debt, this is anything that is probably north of 20%. We know credit cards are what is going to fall in this. When it comes to bad debt, it takes away your power. It takes away your wealth. It takes away really the ability to get rich, not only in the time aspect, but also in the money aspect. When you look at all of your debt, just take the bad debt, add up what you're paying in interest. A lot of people need to physically see it, need to see it written down, a piece of paper, a sticky note, whatever it is, seeing exactly the number that they're paying in debt. For a lot of people can be very eye-opening. Then you can start searching for additional ways through budgeting or through your spending plan to make adjustments to cut that debt down. Every dollar you're not spending to interest, you have the opportunity cost to put that elsewhere. When you think of the repayment, it might take a little bit to get rid of the bad debt, but once it's gone, once that credit card is eliminated, you have the ability to essentially put the money elsewhere. Now, when we think about the elimination of credit cards, 2 really big things that we look at. One, the methodology behind the way that you pay it. You could use the debt avalanche. You could use the debt snowball. Personally, I recommend the debt avalanche to get rid of that bad debt. And the second one is the consolidation or the balance transfer method, which of course is going to allow you to pay less interest over the life of that bad debt, making it essentially go away faster. Now, the only caveat to this, and the trick, is you cannot accumulate new debt. I say this because I see it all the time, where if you have $20,000 in debt, you refinance it, 3 to 5 years later, you have another $20,000 in debt, so on and so forth. The debt snowball continues to go over and over and over again. And unfortunately, when you're paying all of this interest, you are not building any assets. You are just increasing the liabilities because the money is going out month after month after month, even year after year. The third one we look at is utilization of good debt. Now, when we say good debt, this is something low cost financing. This could be a long living asset like a house. When we start thinking of the utilization of good debt, it is what is going to build your assets. When we look at vehicles, we know they are the biggest depreciating asset that we have in the United States. And of course, it is classified as bad debt. Even though there's a good interest rate, it is going to be a depreciation, meaning that if you buy a car today, you use it as your regular everyday car, you're putting miles on it, it's getting older, the depreciation of that is going astronomical. Even looking at some of the new vehicles, they can depreciate up to 20% when you're driving it off the lot. When you look at the price tag, they're running about $62,000 is the average price. Driving it off the lot, you are losing 20% of that value up front. Now, again, getting back to the good debt in step number 3, Thinking about the good debt, such as a mortgage, I know a lot of people might not be in a place to buy a mortgage, but when you think of the value of a home, traditionally, short of 2007, 2008, housing market crisis, the mortgage value has went up. So as you're paying your balance down, and this is where it becomes an asset, and it only remains an asset if you're not borrowing against it. So what do I mean by that? When you think of good debt in a house, taking out a 15-year mortgage, even if you have to take a 30-year mortgage, it might mean that you overbought a little bit in the house. But as you're continuing to make those payments, paying down the principal, you are building an asset over an extended amount of time, 15, 20, 30 years, whatever it is. Now, this is where it turns your good debt or your asset of having a home into a liability is when you do the refinance. When you get 10 years in, so you start a 30-year mortgage, you get back to 20 years, then you refinance it, you take it back to 30 years. That is when it really becomes a liability. And the second way it becomes a liability is if you start borrowing against your home. And I know a lot of people this day and age say that is a great way to do it. But when you start taking out the equity that you built in your home as a home equity, whether it's a line of credit, whether it's, an interest-only home equity, you are taking the asset you're building in your house. Think of it kind of similar as a retirement plan. If you start taking and cannibalizing that retirement plan, you're going to have less of a retirement plan. Well, it's the exact same thing when it comes to your house. When you start taking out home equities, when you start borrowing against your house, that asset all of a sudden turns into a liability. Number 4, save, save, save. If you want to get wealthy, if you want to build and really be rich, you have to spend less than you earn. We always talk about the 3 buckets. The first bucket is your income. Second bucket is your liability. The third bucket is whatever you have left after those first 2. Now, of course, the first way with your income, you can increase your income. This might be a side hustle like we do right here on YouTube. And of course, if you like the content that I'm putting out on the channel, definitely consider subscribing. But like I was saying, with the side hustle, you can increase your income, working more hours, working a side hustle, getting some passive income. This could be CDs. This could be investments that are paying dividends. You could build a passive income portfolio. The second bucket, liabilities. When you think of all of your debt, your mortgage, your cars, your payments, all of your liabilities that you have, you can take that bucket, and if there is any way that you can cut out some expenses, if you can go ahead and get some things cheaper for a majority of people, it might take a little bit of time and effort to be disciplined when it comes to the savings, but you can do it. When you look at insurance products, you can usually find them cheaper. Cutting subscription costs. Right now, on average, it's about $215 a month that people are paying in subscriptions. If you can eliminate $50, $100 in subscriptions, that is going to give you the ability to either 1, debt repayment a lot faster, or 2, give you the ability to save and invest that money, which is why we get into number 5, investing in high return assets. Now, you'll notice in this video, we are talking about assets. These are things that are going to go up in value when we start thinking of high yield savings accounts that are going to give you that 5%. When we start thinking of the S&P 500, specifically the VOO that has a 10% average return over an extended amount of time, you are going to grow your money into more money. And then, of course, if that growth is compounded, you are going to see the eighth wonder of the world go to work with the compounding interest that you're getting in these investment accounts, and it can exponentially go there. Now, of course, stocks are very notorious when it comes to short-term gains or losses. The track record. That is the reason why personally I only invest in ETFs, and I only invest really in a handful of ETFs. And really my 3 ETF portfolio, a great place to start. Even if you're looking at the S&P 500, thinking of Warren Buffett philosophy, he says you should invest in 2 and only 2 ETFs, one of those being the S&P 500, the second one being the bonds, which again, bonds are kind of questionable, but when it comes to having billions of dollars like he does, I guess the bonds can have a pretty good return. Number 6, investing regularly. Now this, of course, is not just dumping your money into the market. It is setting up a very specific portfolio and doing dollar cost averaging. That is one of the biggest things where if you're looking at investing regularly, whether it's in a 401k plan or if it's an IRA or a traditional brokerage account, dollar cost averaging helps you reduce the risk of the investment. And of course, it is not about timing the market. It is about the time that you are in the market. When we think of your investing time frame, we are looking at 5+ years. And let's say, for instance, out of that second bucket with your liabilities, you cut out $100. You have an extra $100 to spend. Putting $100 into an account that just contains the S&P 500, so one single ETF in its entirety, will be very, very beneficial for you. And of course, it is going to grow over time. And the final one we look at is really a preference depending on you and your investment style. This is working with a financial advisor to help you keep on track. So a lot of people don't want to take my advice. They don't want to do ETFs. They want to do stocks. They want to do bonds. When you look at the ability to do your own research, and I really, really recommend, I am not a financial advisor, do your own research when it comes to investing. But if you do not want to put the time and effort into understanding the stock market, understanding ETFs, understanding what you're buying, what you're investing in, this is the place where you hire a financial advisor. Now, majority of financial advisors do incredibly well. It's a very extensive interview process. Your goals and plans kind of have to align with them. You also have to make sure that they're not selling you products and services that are super beneficial to them or that are not beneficial to you at all. And of course, it does come with a cost, usually 1% of your portfolio every single year. Now, remember, this means 1% if your portfolio is doing 20%, great. They're still getting their 1%, leaving you the remaining 19. If the market is down 20%, they are still getting their 1%, regardless of what it is. Now, of course, a lot of investors have really bailed out when times were tough, derailing their wealth building plan. And of course, it gets very, very dicey sometimes, like we've seen in 2022, but sticking and really the bottom line to your investment plan, making sure you know exactly that you're buying assets, how you're going to get rich, and exactly how you're going to be wealthy. Very, very easy to talk about and go through, sometimes very difficult to go ahead and follow. But guys, that's going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video. When you start thinking of a Roth IRA, it is probably one of the best investment vehicles that we see towards retirement, and it is one of the top choices for financial experts. But could a Roth 401k be a better option for a majority of people? That is what we're going to be looking at in today's video. When we start thinking about a Roth 401k instead of a Roth IRA, a lot of employers are now starting to offer this option, including my employer itself, which I am taking full advantage of. Now, a lot of people do not know that a Roth option is available for 401ks at all, and you could be missing out on some big advantages over a Roth IRA. Now, Roth 401k can be exactly what you need to increase your savings while giving you some financial flexibility. In today's video, we're going to be looking at 3 reasons why you should use that Roth 401k instead of using that Roth IRA. Now, the big one, starting with number 1, is the employer match. If you're prioritizing a Roth IRA over a 401k, you could get a matching contribution from your employer, which is free money. When you start thinking about contributions, for instance, you put in 6%, your employer puts in 6%, you are automatically getting a 100% bonus on your money, which is huge. Employers currently can offer up to 25% of your compensation as a matching contribution, but most companies stick between that 3 and 6%. But it's not super uncommon to see employers actually putting in 5 to 10% of your salary, which is great to hear. Now, the catch is to have the contribution within the 401k plan, you yourself have to put in the contributions. So like I said earlier in the scenario, if you're putting in 6%, they're putting in 6%, that is a really good contribution with getting that match. Now, employer matches are usually put into pre-tax account, but now some plans and most plans that do offer the Roth option have the ability with the passage of Secure Act 2.0. If you value the characteristics of a Roth account, it's worthy to talk to your HR, see if there is an option to have a Roth implementation into the 401k. Like I said earlier, that's exactly what we got. This is the first year we do have the option to put our money into a Roth 401k versus putting it into a traditional 401k that ultimately is going to lead into a traditional IRA, which is going to require those required minimum distributions or those RMDs when you hit retirement age. Now, the second option is 401k loan options. Now, this one, even though we're going to cover it, I do not recommend borrowing against your 401k. It is the absolute last investment vehicle that you should use. When it comes to retirement, you are sacrificing your retirement by using a loan option, but a Roth IRA allows you penalty-free, tax-free of your contributions at any time. However, Roth 401ks can give you up to half the access of your account, including the growth, so you can go ahead and borrow that money. The big thing with that is it allows you to withdraw up to 50% of your account balance or up to $50,000 as a loan for yourself if you need temporary cash, if you need something to go ahead and put some money down, which again, I do not really advise this option, but the biggest benefit to this is you have the ability to put the money back in there. When we start thinking of a Roth IRA, if you do the withdrawal from the Roth IRA, you are locked into yearly or annual contribution limits that you're going to get stuck with the IRA. If you're taking 50K out of that Roth 401k, you have the ability to put that $50,000 back into that investment account, which is the reason why I do recommend, if you're looking at doing this loan, Roth 401k loans. Now, the drawback or the catch to this one as well, you have to pay the money back, and most of the money that is paid back comes from withdrawals from your paycheck. So if you're looking at a $50,000 loan, let's say it's over 5 years, not only do you usually owe interest on there, is there could be a penalty if you don't pay it back in time, could be considered a withdrawal. And of course, you're going to have a little bit of a less cash flow if you're doing this out of your paycheck, which of course they do. Well, you want to avoid withdrawing money from your retirement savings at all. If there is truly an emergency, which should be covered in entirety by your emergency fund, you can go ahead and do that 401k loan out of there. And the third one is simplicity. This is the big one that people overlook. When we talk about simplicity, once you set up that Roth 401k, you put the contributions where you want them to be invested, it automatically happens. That is right. It is set up automatically. It is straightforward from your paycheck. You don't see the money hit the bank account. You don't have to do the contributions. Automatic payroll deductions is the way to do it and the way to guarantee that your retirement is going to be fully funded. A lot of people take it from their paycheck if they're going to make those Roth IRA contributions. They take the money, sometimes they do it, sometimes they don't. This happens automatically with the 401k. And of course, the big thing and the drawback with this one, like we talk about with the other ones, is 401ks can sometimes have fewer investment options. That is the reason why when you start looking at 401ks in general is if they have a really good investment portfolio that you can put money into, great. Go ahead and invest, go ahead and max it out, put your 15% in there. And that is what we're trying to get to. When you think of the big overarching how much we're looking to save in a savings account, 15% of your income is the number we're looking for. Now, like I was saying, when it comes to, let's say, matching a 401k of the 6% that we used earlier, if you're putting in 6%, your employer is matching that 6%, and you do not have very good investment options, I would just put in enough to get that employer match. Don't go above and beyond that, even though it is into a 401k plan. If the investment you're putting money into is not beneficial, I would, again, put in enough to get that company match, taking the other percentage, which in this case is that 9%, putting it into a brokerage account, putting it into that Roth IRA instead of that 401k. And that way you know what it's invested in, and putting it into a lot of investment strategies or putting it into something like the S&P 500, which is great. Now, the best way to do this, and I really advise it in all of my videos, is low cost index fund investing. That is what a lot of plans offer, including my own. My 401k plan is a Roth 401k plan. It is invested in the State Street S&P 500. So it is a very, very low cost index fund that follows the S&P 500. Like Warren Buffett has said, 90% of your portfolio in that S&P 500 remaining into bonds, which I don't like the bond case. So putting everything, and I know it's all kind of everything in one nest egg, but when you think about the ETF and the S&P 500, it's not really. If I was investing into one single company, I could absolutely see where putting everything into one bucket would make sense. But putting it into an EFT that tracks 500 different stocks across every sector of the investment strategy or every sector of that S&P 500 index, it makes it well worth it. Now, of course, you don't have to overthink it. You just set it and forget it with the 401k plan, as long as those investments are going into an account that you did your research on and you know what it's going into. So if you're ignoring the 401k option, I definitely recommend switching the Roth IRA money to the Roth 401k. And of course, with the Roth 401ks, you can put a lot more money in when it comes to contribution limits. And of course, you have to know the fees. When it comes to investing in some of these 401k plans, there can be a lot of fees behind it. They can charge you a percentage fee. You have to make sure, but if you're getting that employer match, it is probably going to be above and beyond worth it to get those fees. So make sure, guys, you look into that 401k plan. You know exactly what you're investing in. For a majority of us, the 401k plan is going to be the absolute biggest investment account that you will ever have in your life. putting money in there automatically through payroll contributions for an extended amount of time, getting it to grow during that time, you have to make sure it's properly invested. And of course, I love the Roth options, whether it is an IRA or a 401k, paying it after tax. When you start looking at compounding growth, and this is what a lot of people don't realize, when you start looking at the compounding growth, the ability to put money into an account and essentially take only a little bit out when you get to retirement, but the compounding factor starts going so fast and starts snowballing so large that it's going to be well worth it versus that traditional option, where when you take out the money of the snowballing and the compounding interest, you are getting taxed on that money itself. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video. Let's be honest, you can do better than the VOO and the S&P 500, and that's exactly what we're going to be looking at in this video today. So when we think of the S&P 500, it is the entire market. It is really a measure of the overall health of the stock market. And of course, you have an instant diversification because you're in every sector of the stock market with that S&P 500 fund. If you invested $1,000 into the VOO 10 years ago, reinvesting all of your dividends, you would have about $3,500 today. So pretty good return with an average return of about 13.2% over the last 10 years. We know when you start extending that a little bit further, the S&P 500 yields about a 10 to 11%. Now, of course, this is not adjusted for inflation, but what if you could do even better when we think of that same 10-year return? And in today's video, we're going to be looking at the Vanguard Information Technology ETF, or the VGT. Now, when it comes to the VGT, or this technology ETF, I am personally invested in it. Same with the VOO with the S&P 500. I do invest in both of them because that gives me a little bit more diversification while having a strong focus within that technology. So when you think of this, and honestly, the last 10 years, it has been crushing the VOO or the S&P 500. When you think of the return on this one, you're talking a total return of around 21%. So even again, thinking in relationship to the S&P 500. So if you put $1,000 into this one, you would be yielding about $6,600 versus the 3,500. So almost doubling up your money, which is a big ETF for long-term growth. Also, another reason why I do love the VGT is when you start breaking it down and thinking of what is coming in the future. Now, I know looking at past performance, not always indicative to how an ETF is going to go ahead and perform in the future. But when you think of, and again, these are questions to really ask yourself when you're doing research. Artificial intelligence, do you think it's going to be bigger in the future, more utilized in the future than we are seeing right now? My thought about that, absolutely. Do we think all of these large tech companies are going to continue with a huge expenditure and a huge investment into artificial technology, as well as computers, supercomputers, quantum computing? My thought about that, absolutely. You're going to see a lot more growth in the technology section that you could see in a bunch of these. Now, of course, for me personally, looking at both of these ETFs, I do dollar cost averaging. So what dollar cost averaging is every 2 weeks, I put a set amount into these ETFs. With that being said, it might be $100, let's say, every 2 weeks. If the market's up, great. If the market is down, I am buying it both ways. When the market is up, I buy a little bit less. When the market goes down, I do buy a little bit more, and I do this automatically. That is the way to do it. So when you think of those same 10 years, if you added another $10,000 into the market, which really isn't a lot, when you think $100 a month over that 10-year period, you're looking at $12,000. So the return would be roughly $41,000. So over a 10-year period, you could get about $41,000 into the VG just because of the growth factor. And again, thinking of relationship to that in the S&P 500, if you invested that same $12,000, you'd be at about 25K. So the difference right there, you're talking, making $25,000 in the S&P 500, making 41 in the VGT because of the growth of technology over the last 10 years. Now, one thing to note with the VGT is it does come with additional risk. When it comes to IT and when it comes to the focus in here, a majority of the focus falls into Apple, Microsoft, and NVIDIA are the three largest holdings of the, because it is not weighted, it is really by market cap. And looking at what they're doing in here, it is 48% of this. So if we have issues with Apple, Microsoft, or NVIDIA, this one could make and really have a very big downside, which of course the upside comes with some additional risk, but the downside could be the exact same. That is why when it comes to these technology ETFs, and again, me personally, I only invest in ETFs, and that is all that I will invest in. I don't buy individual stocks, but looking at these is having kind of a very decent risk appetite. So looking at something like the VGT, this is a point where I'd probably put 40% of a portfolio if you're on the younger side, 20 to 40 years of age. 40% into the VGT, into the QQQM could be really good, knowing that you have a very long runway until you get ready for retirement. And of course, carrying the S&P 500. Me personally, 25% of my portfolio is in the S&P 500. 40% is into the VG, into a high growth technology fund, because I still have 20 years to retirement. Looking at what this has done the last 10 years, what I anticipate it to do for the next 10 to 20 years, it is going to have some very, very strong growth potential. Now, of course, like I said, with that S&P 500 fund, you are investing in the 500 largest companies in the United States, which does make a big difference. So let's hop over. I want to check out the VGT, break it down a little bit more for you guys. So let's go ahead and take a look. All right, so right here we have the VGT, the Vanguard Information Technology. Now you'll notice right off the bat, the expense ratio is a little bit higher. It's about 3x higher, but still a 0.1 is very, very cheap. And when you think of investing into funds, into ETFs, when you think of the expense ratios of a financial advisor, they run around 1%. So you're paying essentially 1/10 to own something of this nature. And it's even cheaper to own the S&P 500. So the overview in this, and this is where I want to show you guys kind of what's going on. So the performance in here year to date, 21.43. We're 21.5%, which is crazy. I know the VGT is doing incredibly well. Even the VOO, the S&P 500 itself, is doing incredibly well. And we're going to continue to see that performance the rest of the year. And of course, next year, if the Fed continues to lower interest rates, we are going to see more of an investment on the technology side, because with making money cheaper, there's going to be more borrowing power. Now, you'll notice also that this goes back 20 years. We were just talking about the last 10 years, but I do want to break it down with the last 20 years. Now, of course, risk reward scale 5. This is kind of maxed out, which a lot of these funds are when you start looking at a very strong focus into IT, into information technology. There is a lot that can go down and up with these. Now, performance and fees, this is again where I want to kind of break it down. So you notice the 1 year, we're almost at 30% over the past 1 year. Kind of incredible. But when we start looking at, and honestly, when it comes to investing, when it comes to ETFs, you're looking at the 5-year plus time frame. I don't really pay much attention to the month, the 3-month, the year to date, whatever. Those numbers are really just kind of lost on me, because of course, 1 year looking at 2022 did incredibly poor. We actually seen about a negative 20 to 25%. But then when you look at 2023 and 24, we had a really strong growth, and we are seeing it this year, which again is the reason why I don't really focus on the 1 year. I am more concerned with what the 5 year is doing, the 10 year, and the longevity. So over the last 5 years, you can see 22.94%. So a pretty good yield. 10 year, we're looking at 20.25. So even over the last decade, we are over 20% for the growth in year. And then since inception, so in the last 20 years, it is still at 13%. So it is just hedging out the VOO, that Vanguard S&P 500, by a little bit, which I believe since inception, depending, I think one is a little bit older, but overall performing incredibly well. Now, when we start again looking at the expense ratio, 0.1, so pretty good still with the expense ratio, but I want to show you exactly what we're holding, and this is kind of the difference. So looking here, we have the VGT at 317 stocks. So they are pretty well diversified, even though you're investing into one sector, into that information technology sector. When you think of the VOO, you are in 500 of the largest stocks within the United States. So it does have a lot more diversification, and of course, a bunch of different sectors within there. Now, risk associated with the aggressive fund, but this is what I wanted to show you guys. So when you start looking at this and you break down really what it is, you can see application software, 14%. But look, when it comes to semiconductors, 28, almost 29%. System software, another 20. And of course, technology and hardware, another 18%. 14% application. So you can see this is ultra focused into that information technology, and not just really the AI, but everything that encompasses IT, which again, when you think of diversification, you might not be over all of the sectors, but you are over all of the different parts when it comes to IT. And then when you start looking at companies, this again is something really big to note. When you look at Apple, 16% of the fund, Nvidia, 14%, Microsoft, 13%. So right there, I mean, we have 10, 20, 30, 40. This makes up about the 45 to 48% that we have within this company. But even when you start looking at the ones that are outside of kind of the very core IT AI realm, we have Broadcom, Adobe, Salesforce, AMD is in there, Oracle, Cisco. So again, having exposure to something of this nature will make a big difference, especially being on the younger age, because you have the time for growth. When we think of the next 10, 20, 30 years with something like this ETF, this is where I am changing. And personally, at age 45, I have again 40% into the VGT. We break it up into the SCHD and also the VOO with the rest of them. And about every 5 years, I adjust some of those percentages to where we're dollar cost averaging into a bunch of different ones, into the 3 ETF portfolio that I use. And that is all that I invest in. So in the past 3 years with the portfolio that I built, and you can check out the video, it's down below. But looking at the contributions that we made and also the growth factor, we're up about 81% over the last 3 years because, of course, 2022, a really big down year. We dollar cost average into it every single 2 weeks. We were putting money in there. And then when it rebounded in 23 and 24, we've seen a tremendous amount of growth in there. All right, guys, so that is going to do it for today's video. Let me know if you're invested in the VGT or the VOO or other ETFs that I missed. Now, I did compare kind of the VGT to the QQQM, and it seems like the last 10 years, the VGT does edge it out a little bit, even though it is a lot more focused on the IT, and I feel like that is going to continue in the future. So again, guys, that's going to do it for today's video, and I'll catch you in the next one. When it comes to investing, it can be a very tricky business, which is what we're going to be covering in today's video. Some investment tips that everyone needs to know before we start putting our hard-earned money on the line and putting it into investments. First things first, cleaning up your financial. Before you get serious about money, before you get serious about investing money, look at other financial aspects of your life and what do they look like, including paying off your debts. When you think about investment returns, when you think about the compounding, if you're sitting on that high interest debt, if you have credit cards, chances are you're going to get a lot more kind of bang for your buck if you're paying off and eliminating that debt prior to getting into that investment. Now, of course, when we think about retirement, make sure if your company has a retirement plan, if it has a 401k match, it is something you want to prioritize number one when it comes to investing because you are getting 100% return and you are getting free money. In addition to this, having that emergency fund and having it set up, when we start looking at 3 to 6 months of an emergency fund, there can be a great variance with the amount that you're putting in there. And for me personally, with the emergency fund, it depends on the industry you're in. It also depends if you do have 2 incomes, meaning it could be, a husband, significant other, a spouse, any way that you really look at it. How much income do you have? If one income is eliminated, what is it going to look like? That is going to determine if you're building a 3, 4, 5, even 6-month emergency fund. And also, what kind of job do you possess? Is it something that is sales orientated where your salary can actually, change a lot? Or is it very set, very concise with what you're getting? The next one we look at is spending. There will not be a video where I don't talk about budgeting. I don't talk about the savings plan, the spending plan. You have to know exactly how much money is coming in every month, how much is going out, and what exactly do you have left to invest. When it comes to thinking of the big picture, what are the goals that you have for that money you're investing? Does it mean that you're looking and investing in, the next 3 to 5 years? Are you thinking of retirement? Is it child's education? What is the investment strategy and what goals do you have? Is it you want to retire and have $5 million in the bank? Exactly what is that going to look like? And of course, you don't want to lose sight of that bigger financial picture of exactly why you're doing what you are. And when it comes to investing, thinking about the long term. When we think about long term, when we think about investing, we are looking at 5+ years for investments. This is the reason why when you think of long term and compounding interest, this is where it is really going to come into play, is when you start getting an extended amount of time. When you think of a timeline of 10, 20, 30, 40 years till retirement, you have the ability to compound a lot of the returns that you get in there and also can really exponentially just to the moon with the money that you have in there. Now, of course, like we said earlier, when it comes to research, you can never have too much research. There is no point that reading enough, consuming enough content, looking at financial education videos, looking at trading, investing in stocks and ETFs. There is so much, and over the past 5 years, I've digested an incredible amount of content around investing, around really knowing what we're doing and knowing the industry that we're in when it comes to investing. Now, of course, when you think of investing, when it comes to research, what are you investing in? A lot of people might recommend a bunch of different stocks. They might recommend ETFs like we were talking about. But when it comes into putting your hard-earned money in there, what is the anticipated return? What are you looking for? And what are you investing in? This, of course, applies wholeheartedly to cryptocurrency. If you don't understand blockchain technology, you don't understand exactly what you're investing in and what the risks are associated with investing, I do not recommend under any means to invest. And of course, when it comes to YouTube, when it comes to a lot of different places, don't believe the hype. There's a lot of people that hype up a lot of things, gets views, get a lot of different things. Even looking at the industry, where AI technology is going on, a lot of people are following and putting money into artificial intelligence. And honestly, do your research when it comes to this technology, when it comes to everything. If you're investing in one single company, which of course I do not recommend, putting it into ETFs, kind of risk mitigation, being invested in a multitude of things like the S&P 500, for a majority of people is going to be the absolute best option. Now, of course, you also have to know when to take a back seat, when to sit out, when not to play the game. When you think of the hype of Bitcoin, when you think of Ethereum, when you think of all the ETFs, a lot of people bought into them and then a lot of people lost money. When you start seeing kind of the trends and seeing everyone talking about the exact same thing of what's coming, this is really where you might be too late to the game. When you think of Bitcoin and when you think of a lot of people that have made, multimillionaires out of it, if you don't understand what you're investing in, like we said before, do not invest in it. Now, of course, when it comes to investing as well, being more protective about the investment, this is the risk mitigation. When you think in looking at companies, are you a person that buys and holds? Are you a person that will buy a company or invest and sell it for a short-term gain? You have to know exactly what you're in, and you also have to know what your risk appetite is. Are you willing to really put a large sum of money into a very risky investment? Of course, there could be a big upside to that. There could be a big positive side, but you could also lose your initial investment or even more money depending on how you're doing it. But there's also a time on the flip side when it makes sense to be greedy. When you think of times to be greedy, this is when you can buy ETFs cheaper. Now, me personally, this is when I take full advantage of it. The time to be greedy is when we see a dip in the market. Thinking back a couple years to 2022, when there was, markets were down about 18, 20, 25%. That was the time you were buying it discounted. When you think of the time to be greedy, that is it. It is. When you think of ETFs at a 20 to 25% discount, that is the time you want to go ahead and you want to pump money into this, because of course we are looking at not timing the market, but being very consistent and having the ability to buy when the market is lower. And when it comes to purchasing those, we talk about diversification. There's no time when it comes to investment tips that we will not talk about really the diversification. You do not want all of your eggs in one basket. You don't want everything into one. Now, there's going to be a couple things to remember this depending on your age, your interest, the investment capabilities, what exactly you're looking for. The investment portfolio is going to be different and it's going to be a different landscape for everyone. This is where the diversification comes in. Something like that S&P 500 where you're in every single sector in the market and across a plethora of companies makes a very, very big difference. Now, when you start looking at this, look at the prospectus, look at the companies, look at the ETFs, look at the data sheets that they provide to you to see exactly what it's going to be. Now, of course, you cannot really predict any future growth, future changes, future anything when you look at what happened in the past. However, when you start looking at data at a bigger scale, it makes sense. When you look at the S&P 500, it has made about 10% every single year. There's nothing to say in the future we're not going to see that 10% gain over an extended amount of time, that it's not going to be going anywhere. And that is where people continue to invest. So when we start thinking of the stock market as well, you have to zoom out. You have to take a step back. When you think of it being a very bumpy ride, it's going to be ups and downs. You're going to have highs like we're seeing this year where the S&P 500 is up 20%. But are you an individual that can handle the downs, that can handle when the S&P 500 is down 20% and you're losing, thousands, tens of thousands, hundreds of thousands of dollars, depending exactly how much you have in there. Now, when it comes to investing and when it comes to putting money into the investment, you have to take emotions out of it. This, of course, took me an extended amount of time to be able to do, taking my emotion out of here and really looking at the numbers. People will see the market go down, they'll see it go down, boom, they start selling. So they're selling it at a much lower value than what they possibly bought it at. But then again, on the flip side, what happens is emotionally, we start seeing something going up, looking at NVIDIA, we start seeing the green, we start seeing the growth, we start seeing it take off. All of a sudden, people are right on board. They're on the trend, they're throwing money into NVIDIA. It continues to rise, it continues to rise. Well, there's a point, price to earning ratios, where a company will pull back. They're not, and they're really overvalued at some sense. Not saying that NVIDIA is right now, but overall, you have to think and you have to take that emotional aspect out of there. And of course, take headlines with a pinch of salt. Do your own research when you start thinking of companies and when you start looking at what is in the headlines today, what is in the headlines tomorrow, what is going to be there in the future. Bad news can drive a stock down, but majority of the time, it is very, very temporarily that we see the stock pull back or really do some recession. And of course, reinvesting. This is a major point that people have to get when you think of reinvesting your dividends, reinvesting your capital gains, reinvesting. This is where the compounding comes in. There's going to be a point in life where you might want to take some out of this investment, but it keeps and helps your portfolio growing much faster and really slingshots it into a very easy part. Now, when we think of simplicity, this is another one. When you're choosing stocks, when you're choosing ETFs, you really should consider index funds. Again, that's exactly what I invest in and only what I invest in my 3 ETF portfolio. And I do change my percentages through time. But overall, imagine if you just put in something like the S&P 500, investing in the VOO or the SPY. Putting your money in there is going to yield you roughly 10% every year. If you have it for an extended amount of time, you are going to see that growth. When it comes to investing, it is very time consuming. When it comes to just leaving your money there, it's very boring. When you see films and when you see a lot of trading, day trading and the ups and the downs and everything, for majority of investors, think of your 401k. Think of putting money in there every week or every 2 weeks when you get paid. It is going to grow over time and it's going to grow over an extended amount of time to build the portfolio that is required when it comes to retirement to actually be able to live the retirement that you want. And of course, you have to think of fees. Watch out for fees. 1 to 2% doesn't seem like a lot. When you start compounding it over 30 years, that could be roughly 20 to 30% of the value of your portfolio because of fees that you look in there. And the biggest thing when it comes to investment is consistency. We always talk about this dollar cost averaging. If you're putting money in there every 2 weeks, if the market's up, that's great, you're buying. If the market does go down, that's great, you're buying it at a discounted rate. Putting money in here and continuing to invest on a regular basis. You don't have to make investing complicated. Doesn't have to be super difficult to understand. Even when it comes to an ETF, if you just put it into one, like the S&P 500, you would do incredibly well when it came to the returns. So, all right, guys, so that is going to do it. Investment tips everyone needs to know, and these are just the very, very basics. As we continue, please subscribe to the channel. We'll get a lot more in depth with the investing strategy, and thank you guys for watching.